Shares and bonds of Chinese real estate companies slid on Thursday, reflecting uncertainty about how a debt crisis will play out in China Evergrande Group and the wider property sector as another developer was hit by a rating downgrade. This continues to be a sliding issue here. But I want to caution everyone to still not panic. But, it never hurts to maybe have some cash, on hand for purchasing in case things do go down, because I want you to be able to use that cash to go and make purchases, whether it's shares of stocks or property or things like that. If things, I hope they don't go this way. But more, as they say, more millionaires are made in bad times than in good times. Anyway, Evergrande, which has more than 300 billion in liabilities and 1,300 real estate projects in over 280 cities, missed a third round of interest payments on its international bonds this week. The world's most indebted developer, which has been trying to sell assets to raise funds, appeared to have made small progress towards the goal when Kwame's Home Furnishings Group announced in a filing on Thursday that it will buy out Evergrande Group's 40% stake in their furnishings joint venture for 72 million yuan, or $11.18 million. But in a sign of its continued cash flow problems, municipal officials said Evergrande has yet to make $28 million payment for land it acquired in the northeastern city earlier this year, and that's I guess that's Changchun. Other Chinese developers have also warned they could default on bond payments, and rising risks on Wednesday led rating agency S&P Global to downgrade two of the sector's bigger companies, Greenland Holdings, which has built some of the world's tallest residential towers, and eHouse. S&P also said it would cut their ratings further. On Thursday, Fitch Ratings issued the latest downgrade, cutting Modern Land China Company to a single C rating after the developer said it was seeking consent from investors to extend bond maturity by 3 months. Investors have been hoping China would ease monetary policy to stabilize its wobbly recovery, but data on Thursday showed China's annual factory gate prices rising at the fastest pace on record in September due to soaring raw material costs. But the most important policy in the property sector is not monetary policy, but the regulation related to leverage and the bank loan supply to developers and home buyers. Therefore, I think the government still has the option to loosen those policies to help the property sector. The big question is whether they are willing to do so. So far, their policy stance seems quite firm. On Thursday, a sub-index tracking shares of Chinese property developers ended the day 3.88%, or down 3.88%, while the broad CSI 300 blue chip index slipped 0.54%. Property shares have fallen nearly 20% this year, and compared to the 5.7% fall from the CSI 300. JP Morgan analysts said China property shares would remain volatile in the near term. News on the marginal easing will likely cause a short-term rebound, which, however, may not be very sustainable due to the likely ongoing concerns on the offshore bond market. A more sustainable rally may happen in January 2022 when banks have more front-loaded quota to extend credit to developers and mortgages. So, it's definitely not a good sign that any of this is happening. And like I kind of said a little bit earlier, I think it's important that if you have the ability to maybe move to cash, having cash on hand to buy, for more buying opportunities in the near future, might not be such a bad idea. But it's not necessarily we don't want to go selling every asset and then selling the farm or anything like that. But just be aware that like things could continuously have this domino effect that could absolutely affect the entirety of the world. And I don't personally want to see it, but I want you to be prepared for it if something, some opportunities come around because of this, even if it's on a smaller scale than like a global financial crisis like in 2008.